Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. The U.S. equity market climbed to all-time highs in the last session. That was after Wednesday's Fed rate cut, and money flowed into riskier corners of the market. Look at small cap shares. They simply soared. We had the Russell 2000 jumping 2.5%, closing at its first record high since 2021. Now, this index is home to some of the riskiest and most indebted companies in the market. At the same time today, we had the Dow, the S&P, and the Nasdaq finishing at records. In a moment, we'll take a look at how Stephen Miran's appointment to the Fed could lead to a weaker dollar and benefit EM currencies. I'll be joined by Bloomberg opinion columnist Shuli Wren. But we begin here in the States. Joining me now is Shams Afzal, Managing Director at the Carnegie Investment Counsel. Shams is on the line from Toledo, Ohio. Thank you so much for making time to chat with me. It's very interesting to look at what happened in the bond market today. Yes, we had a rally in equities, but yields were up across the curve. And this seems to be tied to the idea, Shams, that the Fed is going to allow the economy to run hot. Is there some danger here, though?
There could be. I'm not quite there yet in terms of overreacting to a single day move, but it can be very much interpreted that way. So if you look at the dot plot, obviously from yesterday, while we did get an extra cut expected for this year from a consensus standpoint, 2026 is really essentially flat, right? If you look at the consensus for 2026, most people are still gravitating towards barely any movement from where they leave off in 2025. So that should potentially keep things in check. But, you know, the bond market has widely been known as be home for more sophisticated investors than equities. So we have to pay attention. That we cannot ignore the bond market, of course.
Yeah, Powell called this move a risk management cut, but he also reiterated the danger of those tariff hikes creating a persistent uplift in inflationary pressures. And that's, I think, maybe what was being expressed in the Wednesday session after the Fed's decision, because we also had yields pushing a little higher. Are we looking at a situation where stagflation is a possibility?
You know, it depends. You know, when we think about the spending and where it's coming from, $1 worth of spending is the same, you know, whether it comes from one source or 5 different sources, right? So while we are not so enthused with the idea that the AI theme is really what's powering a good chunk of the economy, but, you know, generally GDP calculation will be fairly neutral to where this boost comes from. My assessment is that for stagflation to truly take shape, we're going to have to see a sea change in terms of the hype that we have seen over the last couple of years towards data center build out. That number is so substantially high. The fact that it's likely going to touch 1% of US GDP, most likely in 2026, keeps me at bay from thinking that stagflation is around the corner. But you know, I wouldn't be betting that we're going to skirt by a recession over the next 12 months either.
Well, let's stay with that. I'm wondering whether or not you believe, given the ferocity of investment in AI infrastructure, whether investors are going to see an ROI, a return on investment.
Well, I think the corporations themselves are seeing it. Now, I'm not speaking about the owners of the LLMs at this point, because that's a whole different story altogether. But when you see the way really Fortune 500 is deploying these things, obviously there's customer service, and then there is the sort of the first level, brand new graduate, you know, analytical abilities. These are the areas where we're going to see a lot of weakness, I think, over the next couple of years in terms of the job market, because that's where I think some of the substantial gains in productivity is going to come from. What you look at, whether it's the health insurance industry, whether it's just a simple chatbot being deployed across the board, or the agentic AI, the no-code AI agents that are being deployed to handle a variety of tasks across the board, I think there's some significant productivity gains awaiting around the corner. So I think Fortune 500 is pretty good. As far as the small businesses that may be still running on Windows 10 or older, I think there's going to be a significant dichotomy between how the rest of America ends up using the advancements in AI versus how Fortune 500 ends up using it.
Well, speaking of small companies, we had a rally in the Russell 2000 today. It was up about 2.5%, as I indicated a moment ago. Give me your sense on whether this was a little bit of a short squeeze here, or whether the market is genuinely convinced that there is going to be kind of a resurgence in some type of economic activity that would justify pushing small cap stocks higher.
Well, it's probably not a great idea to read too much into a single day move, but as you mentioned, that Russell 2000 is home to a lot of unprofitable companies, and therefore riskier companies, high speculation, biotech, and frankly, a lot of regional banks and mortgage companies for that matter. I think the way we are sort of absorbing this turn of events is essentially to say that, look, from a historical perspective, when the Feds have cut rate, they have generally done it when it's already too late. So historically speaking, you would have found over the last 30, 40 years that a rate cut happens and then we slide into a recession. I think Chairman Powell is going to be one of those people celebrated, I think, in later years, because he has had now 3 different incidents where he's had the chance to raise rates. The first 2 times, he did not drive the economy into a recession. We'll see how it looks this time around. My sense is that Goldilocks economy that's growing at around 1.7 to 1.9%, corporate America still crunching in double-digit, profit gains, obviously aided by the weaker U.S. dollar. All of this does lend itself to Russell 2000 finally catching, some ray of sunshine. So I think there is some momentum that could build up if we do get a Goldilocks economy, while we are expecting rate cuts, at least 4 rate cuts between now and maybe summer of next year.
So what about the broader equity market today? S&P 500 at a record high, and a PE of around 25 times earnings. That seems to be a little frothy.
Very much so. Obviously, the weighting on mega caps is also the highest it's been since, frankly, 1890s. If you go back to the last 50 years, on average, the top 10 names by market cap has trended around 25 to 28%. As of July of last year, the last time I took a look at this, the top 10 names comprised of 38% of the index, right? So if the mega caps that are all participating in this AI hype are going to be the ones to be the largest names within an index, you can imagine why we're going to get a little bit stretched on the valuation front. I don't think that still concerns me as much, because the rest of the index is really around 19 to 20 times, and that's manageable. If you had 7 or 8 sectors out of the 11 all trading over 20, 21 times earnings, that would be more reason to worry than, frankly, knowing that the market is concentrated. And as long as the AI boom is happening, you could look the other way. But boy, watch out when this hardware build out is about to complete its full cycle. That's when the concentration may not be working for investors as much.
So having said all of that, Shams, give me an investment strategy that you think will be effective over the next 6 to 12 months.
Well, I would say that mega center banks are going to be, a good place to invest at this point. The valuations are not eye-watering. And I think between the prospect of just having a better spread in net interest margins, as well as the prospect of deregulation over the remainder of the term from the administration, both bodes well for financials. Obviously, I think we're still early stage in AI. So to the extent that you're able to find names that have not completely sort of gotten blown off with this eye-watering rally, I think there may be some deals there. I think AMD may have given us an opportunity today as a result of the news between NVIDIA and Intel. And so pockets of opportunity within tech, certainly financials. And I wouldn't completely ignore consumer discretionary at this point, because the first half, was very subdued in terms of economic participation. I think the second half will be much better, and we think 2026 may actually carry the momentum. So there should be some really strong names, both in retail or otherwise, within the discretionary sector that can really make investors' goals come true for the next year.
What about foreign markets? We have President Trump returning from the UK. A lot of big tech deals were just announced. Are you inclined maybe to look for opportunities outside of the U.S. right now?
It's we have really been underweight in international as a firm for the longest time. And while we felt that, maybe a year ago, Mexico would have been an opportunity and maybe some parts of Asia would have been, post-tariffs, we're not so sure. And when we look at our multinationals here and how they're speaking about where the momentum is across the world, we're not really seeing bright spots out of really any place in Europe, perhaps maybe Poland to some degree. But overall, it's a very much a very tepid market that is basically burdened by excessive regulation. And so we're just going to be waiting and seeing on whether there's a truly sort of a change of mindset in terms of how they think through the next 20, 30 years. Otherwise, I think the U.S. remains the best bang for the buck as far as we're concerned.
Okay, Shams, we'll leave it there. Bang for the buck in the U.S. Shams Afzal is Managing Director at the Carnegie Investment Counsel, joining us on the line from Toledo, Ohio, here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Now, the Fed's recent decision to cut its policy rate by a quarter point was nearly unanimous. The newly installed Governor Stephen Miran, though, dissented in favor of a half-point reduction. Now, that is something President Trump has been demanding for months. Miran was sworn into the Fed's board on Tuesday morning, just in time for the meeting. He has taken unpaid leave from his role as chair of the White House Council of Economic Advisors. To help us understand what Miran's new role may mean for markets, I'm joined by Bloomberg opinion columnist Shuli Ren, who joins us from Hong Kong. Shuli, it's always a pleasure. Thank you so very much. I know you're writing about Miran's policy where the dollar is concerned. Fill me in a little bit.
He's definitely a dollar bear. He blamed the U.S. society's various economic problems, from the loss of manufacturing to wealth inequality to the overvaluation of dollar. In a very well-read paper published last November, he basically called He basically said that the dollar is overvalued and that it should not be acting as a reserve currency. And that's very much freaking global investors out. Like, what we are seeing is that the Fed was holding the rates, right, throughout this year until Wednesday. But the dollar, the broader dollar index has come down 12% already.
Do you think he's likely to have much in the way of influence while he's sitting on the Fed's Board of Governors?
He is only one of the 7 members. However, his rhetoric and the fact that Trump will get to decide on the next Fed chair do influence market narratives. And you are actually seeing it already. For instance, gold is on track to take over U.S. Treasuries as global central bank's biggest reserve assets. That's a sign that global investors are trying to hedge against the instability at the Federal Reserve. And also, what you are seeing is that global asset managers are increasingly keen to diversify overseas into international stocks, from Europe to Hong Kong.
So to be fair, Shuli, the dollar has been in a bit of a downtrend for much of the year. How much of that is due to forces maybe that Miran or anyone else would not be able to control?
I think that's a very fair question. What you see with dollar is that it tends to exhibit very long-term major cycles, with the boom and the bust phases lasting over a decade. So it does seem that the dollar has peaked somewhere in 2022, and the consensus is that, after the last boom, which lasted over a decade, the dollar may be entering a bear phase. I will only say that Trump's economic policies and his attitude towards the Federal Reserve is speeding up that decline.
So I mentioned that Miran is on leave from his role as chair of the White House Council of Economic Advisors, and we know a cornerstone of Trump's economic policies have to do with tariffs. And I'm wondering whether we need to talk a little bit about the tariff story as it relates to the dollar as well.
Well, and that's another problem, right? Like in the past, a lot of foreign governments, they ended up holding a lot of dollar because they were exporting their goods and services into the United States. But if the tariff war is set up, there is less need for them to hold dollar anymore. In fact, there will be, in the case of China, there will be few opportunities to earn dollar, right? That means that there is a lot of selling pressure on the greenback.
So if we step back and we look at the shift that is happening right now in global markets, is this a time where many, I will say, especially institutional investors are diversifying, and perhaps some of that diversification is moving assets out of the U.S.?
I think we are already seeing that already. Europe and China have been doing very well this year. And it's also in part because the U.S. stock market has become very expensive, right? Like if the AI boom is not showing up in the earnings in, say, 2026, 2027, then the U.S. stock market is just way too expensive. So there are incentives to move out anyhow.
So we know that when you are involved in the foreign exchange, it's always a pair that you're talking about, a dollar related to another currency. And I'm wondering if we can talk about the path of the dollar to the downside. I'm wondering what currencies will benefit on the strong side beyond the Japanese yen?
So if you look at emerging markets in the last couple of months, emerging markets currencies that offer quality carry trade, and I'm talking about those from Brazil, Mexico, and South Africa, they have been rallying the most. It's a sign that the carry trade is back and the people are using the dollar as the funding currency to buy into higher yielding currencies.
Shuli, we'll leave it there. It's always a pleasure. Thank you so very much. Bloomberg opinion columnist Shuli Ren joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.